Hello everyone, welcome to VAT in Short series. Today in this video, I'll be talking about specific scenario related to input VAT. Now in course of doing business, we have seen that there are cases where goods are lost or stolen or expired goods that needs to be disposed of. There is a shortage or a shrinkage in inventory count, or let's say a stalled real estate project. Now in these cases, generally the companies would have recovered input VAT at the time of purchase. But what happens when the goods are written off? Whether the company is still entitled to input tax credit, or does one need to reverse the VAT already recovered? Let's find out in this video. Now if you look at the VAT laws in the three countries, UAE, KSA and Bahrain, the input tax can be recovered on the premise that goods are used or intended to be used for making a taxable supply. Similarly in KSA and Bahrain, it is provided that if it's in course of an economic activity and if it's part of a taxable supply, then input tax can be recovered. Now clearly based on these provisions, one could argue that there was an intention to make a taxable supply and therefore input tax should be recoverable. However, one has to be mindful for the fact that there are specific provisions related to adjustment where input tax needs to be reversed in certain scenarios. Now what are these provisions? Let's start with the first one being Unified GCC VAT Framework Agreement. Now it provides that if there is a loss, damage or a theft, no input tax adjustment will be required, only if the taxable person is able to establish through the conditions and provisions as may be provided in each member state. Now if you look at the KSA and Bahrain VAT laws, it is provided that no adjustment will be required in line with the GCC VAT agreement. However, one has to be careful in maintaining the accounting records or official record to evidence the claim. The authorities may ask for additional documents in terms of police report or an insurance claim document to claim the losses. In absence of these evidences, the input tax may be denied on such goods during the VAT audit. Now, if you look at the UAE VAT law, there has been a bit of an ambiguity. There are two schools of thoughts on this particular issue. One being that there is no specific provision unlike in KSA or Bahrain, and therefore, based on the intention to use, the input tax should be recoverable on such scenarios. However, there is a second school of thought to say that input tax has to be adjusted because there are general provisions related to input tax adjustment post recovery, which provides that if before the actual use of the goods, the input tax is not attributable to a taxable supply, then it needs to be repaid back. Clearly, there is an ambiguity on this issue and needs to be seen how the position evolves over the next few years. In the meantime, what should be the way forward? In our view, the businesses should evaluate various scenarios and understand what are the documents being maintained currently. Seek a professional assistance to examine the documentation and whether it is adequate to recover the input VAT. Quantify the VAT exposure for the past period, and most importantly, obtain a FTA clarification on this particular issue to get clarity and avoid penalties. With this, I'd like to conclude my video. If you have any queries or require any clarification, feel free to reach out to us. Thank you very much.